So you ever notice how prudence is not popular, especially during times of down markets? When the market's down, we tend to react according to our instincts. Human instincts, you've got fight or flight, you've got the draw to pleasure and draw away from pain. And so what do you think many investors do when they're in the hot zone, so to speak? You're in that hot state where you've got fear, the markets are down, the values are down. And it doesn't help that we've got the media saying all the things that they tend to say during downturns. What do you think most, if not many, investors do? Well, if you listen to the Wall Street Journal during these times of downturns or crashes, as they'll call them, you'll hear that billions of dollars were lost in the market this week. Millions of investors lost. How does that happen? How do they lose? They have to sell. So does selling your positions in a downturn, do you think that sounds prudent? No. So why do people do it? Well, one, they may not have a coach. Two, they probably are listening to the media. Let's take a look at just some specific examples of what we hear from the media during these downturns, and you decide for yourself whether they're there to help you or hurt you. So you have the crash here of February 2001 to February 2003, 22 months. Now, it's not fun when you're in the downturn. You just can't wait, any day. You just want it to be, you want the pain to be over. You want your values back up. The S&P had a negative 36% return. And then you've got Time Magazine putting covers and articles like this on the cover of their magazine, the bear market, and wanting to scare you, and when will this ever be over? And then, to top that off, we've got some quotes from your friends, the media. U.S. News and World Report, a reputable magazine. But what do they say during these downturns? Fear of a market freefall. The Associated Press. Most Americans have lost faith in the stock market. Now, do you think that's true? Now that we're in a bull market, your values are up, everything is good, we can look back and say, that's ridiculous. Of course Americans haven't lost faith in the stock market. Well, and you're right. But when you are in a down market and you give in to fear and you listen to statements like this, you may buy into it, or some folks may buy into it because they don't know what's going to happen next. Perhaps they think the sky's falling. Well, here's one thing we know does happen next. I don't know if you can see that or not, but here you've got the S&P, and here you have a properly diversified U.S. portfolio after this crash. See a lot of growth here, don't we? So did we lose faith in the markets? Not at all. 1 year after this market downturn in February 2001 to 2003, a 43.95% return in 1 year. 3-year average of 20% per year. So was the media right? No. Are they ever right? Not when it comes to these crashes. Let's look at another one. The crash. September 1987 to October 87. You remember that? I was in college and I was in a class and I remember them talking about Black Friday and the market's crashing for a whole 2 months. What do you think people did? They broke the number one rule of investing. You don't sell when it's down, but that's what they did. Many did, and that's how you take a loss. And what they missed out on, not only did they lose by deciding to sell when their values were down, but they missed the recovery. So yeah, the S&P dropped 23%. And then Time Magazine doesn't help by putting on their cover, the crash. After a wild week on Wall Street, the world is different. Really? Is the world different? 23 years later, is the world different? Now, I know we have our new set of crises, but even today, as we speak in 2011, the S&P is almost double what it was in the low point of the most recent past bear market. Is the world different? How about some quotes? Technically, the crash of 1987 bears an uncanny resemblance to the crash of 1929. Yeah, whose buddy is that? George Soros. Or the New York Times. What do you expect us to do? Announce that all the cabinet members will be buying IBM and General Motors stock tomorrow? That was 87. A little prophetic, isn't it? But when you're in the midst of this and you have no guidance and you're going on your gut or your instinct, can you see how easy it is not to be prudent and to give in to this fear? The borrowing has to stop. The market slide was a shot right between the eyes that had better wake us up to the simple fact that we can't keep romping forever in borrowed money. Lee Iacocca. Well, here's the point. Since 1946, it has taken on average 111 days for the market to get back up to where it was before it went down after every crash. After every crash comes recovery. So if someone does not have a plan, they don't have a coach, someone to help keep them with their head on right and to think clearly and to stick with their plan, they will break the rules of investing and sell low. Not only will they take a loss in selling low during the crash, but they will miss out on the recoveries. The recoveries come after the crash, and sometimes they come fast and furious. So you don't want to give in to what the folks on TV are saying or some of these magazines. You better go to cash, better stop the bleeding. You take a loss, plus you miss out on the growth. Volatility happens in the market, and that's how you make money. That's how you get your risk premium returns. Without that volatility, you end up with a CD. We all love the upside volatility. We love it now. But what about when the markets move down? And they do. The prudent investor will benefit. You'll be rewarded for volatility and not be punished if you don't allow yourself to give into the fear that is also exacerbated by the media. So what does it all mean? Recovery comes fast and furious. You are rewarded for the volatility in the market, and it requires faith and courage and to stay the course of your well thought out plan with a properly diversified portfolio. You check timrosen.tv and request a copy of my investor awareness guide if you need more information or if you want to talk about what properly diversified means in your portfolio, or if you want some coaching. If you don't already have unbiased coaching, then you can shoot me an email at tim@timrosen.tv. See you next time.